Hey everyone, it's Zach back with a new mortgage video. Hope you all had a happy weekend. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So on today's Monday mortgage market update, I'll talk a little bit about last week, the Fed rate decision, continuing to see a return to the data dependence you want to see, and then talk this week about more non-data stuff to focus on with escalation of the US's involvement in Iran, along with a couple reports to keep an eye out for. So last week, we did see a continuation of a return to a data focus, which is a good sign. On Tuesday, we had retail sales, which is another one of these early in the month inflation type of readings. And that number came in a lot lower than anticipated. The markets were expecting a decline in retail sales month over month, but the decline was steeper than expected by a decent amount, and that led to an improvement in mortgage rates as you would expect. Now, on Wednesday, the Fed had their rate decision, which everyone expected would be a rate pause, and it was. What was not a sure thing was whether on the latest dot plot, which is the Fed's projections for various economic indicators the rest of this year and years in the future, it wasn't a sure thing that we would see the Fed still anticipating 2 or more rate cuts in 2025. The last Fed dot plot in March, they were expecting 2 rate cuts. The markets, CME group, are still expecting 2 rate cuts. There was definitely a possibility they would downgrade that, but they did not. They still maintained an expectation of 2 rate cuts, even though there was less of a consensus about that than there was in March. And that led to a pretty muted response toward the Fed rate decision. Then over the weekend, we have the news that the US fired missiles on Iran. How would that affect the market? So far, mortgage rates have improved. And I think it's a combination of a couple things. One, not just the Iranian conflict, it's also the fact that now multiple Fed members have said that they would support a rate cut in July. Right now, the CME group is projecting a 22% chance of a rate cut in July. That is up from 14% just on Friday. So I think that's having an effect, but also a tendency with war is it creates uncertainty, and that can lead towards this inverse relationship between stocks and bonds, where during uncertainty, investors tend to move away from stocks and towards bonds, driving the prices down. Now, stocks are actually up today as well, so that's what makes me think it's a combination of things. The things that I'll be keeping an eye out for, and this is probably not going to be a this week thing, the length and the extent of the US's involvement in Iran. Are we going to spend a lot of money, potentially raising the US deficit, which has come into focus recently? If so, that's probably bad for mortgage rates. Or is this going to be a short, temporary thing? Very well could cause a rise in oil prices, which would probably have a negative effect, although the Fed doesn't focus as much on oil and food as the other elements of inflation. So I don't know if that'll have as big of an effect as a lot of people are thinking. But besides the conflict with Iran, we also have another initial jobless claims report, which is projected to stay in the elevated range of 240,000. This is definitely pointing towards we're probably going to see some uptick in unemployment during the next release of unemployment rate. We've now seen, I think, 4 weeks in a row where initial jobless claims is over 240,000 after it had been 210 to 220. So definitely some signs of weakening in the labor market. That'll be worth watching. And then on Friday, we have personal consumption expenditures, the Fed's preferred metric of inflation, which, by the way, the Fed is expecting that number to rise by the end of this year. They're expecting it to rise from mid 2s to low 3s by the end of this year. So again, the markets usually can more accurately predict personal consumption expenditures, but if that comes in outside of expectations, it could definitely move the needle as well. If you have any questions, shoot a comment below, or if you need anything from me, feel free to call, text, or email me. But thanks for tuning in to this update, and I will see you next time.